Hey everyone, welcome back to Corporate Decoder, the place where we crack open those dense corporate filings so you don't have to. Today we're diving into Fluent Inc.'s latest quarterly report. Let's just say things aren't exactly fluent for this company, but we'll get to why soon enough. This report paints a picture of declining revenues, increasing losses, and some serious doubts about the company's future. Is Fluent just hitting a rough patch, or is there something more fundamentally wrong? Let's find out. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us to discuss the insights. Scroll 31, 2025 numeric FIR. First off, this report covers Fluent's financial performance for the first 3 months of this year, ending in March. As with all these reports, the numbers are in thousands, unless we say otherwise. Let's dive straight into the consolidated balance sheets. As of March 31st, their cash and cash equivalents were about $4.8 million. That's down from about $944 million at the end of the previous year. Accounts receivable, the money owed to them, is at $37 million, also down from $46.5 million. Basically, they're holding less cash and people owe them less money. Total current assets, which are assets that can easily be converted into cash, are $51 into cash, or $65.9 million at the end of the prior year. At $77.4 million compared to $93.6 million. So assets overall, all of them are also lower. All these are concerning. On the other side of the balance sheet, liabilities look a bit more stable. $51.6 million compared to $64.6 million. So even though liabilities are down, the asset decrease is far higher and more concerning. At 55 ton for Bornhjorst Porter, $68.6 million. And finally, to summarize, shareholders' equity, which is a representation of the net value of the company, stands at $22 million compared to $24.9 million. That's a pretty significant downturn. Now let's move to the consolidated statements of operations, which tells us about revenue and expenses. The company generated revenue of $55.2 million, but their total costs and expenses added up to $62.2 million, leading to a loss from operations of $7.076 million. That's compared to a loss of $3.9 million a year prior. So not only are they losing money, they're losing more money than last year. After accounting for interest expense and income taxes, their net loss is about $8.2 million. In simple terms, they're spending a lot more than they're bringing in. That said, much of the revenue decline may be attributable to market sector changes due to their focus on regulatory compliance. To summarize, on a per share basis, their basic and diluted loss per share is about 39 cents compared to 45 cents last year. Let's check the cash flow statements. Cash from operations this quarter was a gain of $2.1 million. But then cash used in investing activities amounted to $1.5 million. And cash used in financing activities amounted to $5.1 million, meaning that they ended up with about $6 million in cash, cash equivalents, and restricted cash at the end of this period. Now, let's take a look at what the company itself says about its financial health and future. I always find this section to be very important, since the following statement means we need to do this or we're going out of business. Here's where it gets interesting and a little scary. They say that management has concluded that there is substantial doubt about the company's ability to continue as a going concern for 1 year. In simpler words, the company is saying they're not sure they can stay in business for the next year. They have a lot of debt, and their forecasts suggest they might not be able to meet the requirements of their loan agreements. If they can't comply with those agreements, the lenders could demand immediate repayment, and in that situation, they would have no ability to repay that amount, it sounds like. They are trying to get more money through something called securities purchase agreements. If the offering occurs, they will receive approximately $4 million. But even with that money, there's no assurance they'll have enough to keep things running. The company may need to take further action, like implementing cost-saving measures. All of this analysis leads them to determine that they are unsure if they can remain in business, and so the rest of the report should be read in that lens. They made the decision to disaggregate their revenue so we can have a little bit better of an understanding of what's driving the money. So let's take a look. For the 3 months ending March 31, you can see the Fluent part of the business, their primary business unit, brought in $53.8 million, while all other revenue totaled only $1.3 million. But in the comparable prior period, Fluent made $57.9 million, and all other revenue came to $8 million. They're also talking about how they recognize revenue, whether they're acting as the main provider or just as an agent for another company. Another thing to quickly check is their intangible assets, things that are not physical but important to the company. The total amount is around $21 million. Next up, let's check out their long-term debt and any fair value calculations for financial instruments. The company owes money pursuant to a credit facility that had an outstanding principal balance of $21.7 million, and also junior secured promissory note, and the convertible notes with related parties worth $3.8 million. One thing to note is that they have a subordination agreement that has restrictive covenants that prevent those notes from being paid out over the credit facility lender. These convertible notes can be converted to stock, with each share valued around 3 tauses, a high premium over their current value. In terms of the fair value, their liabilities are broken down into level 1, 2, and 3, depending on the type of input assumption and calculation that's being done. A key detail for our use is there were no transfers between level 1 and level 2 fair value measurements during the periods presented, meaning that they did not suddenly become worth more or less for complex accounting reasons. Next, the company records a full valuation allowance against net deferred tax assets. To simplify, they're not expecting to make enough profit to pay taxes anytime soon. This reflects their current financial challenges. The way Fluent's business is broken down helps us understand where revenue and losses come from. A big part of their revenue comes from the United States, and about 20% of the consolidated revenue has come from customers located in Israel as of this filing. Checking for lawsuits is also a must, and it seems that means that they don't have any significant lawsuits that might affect the business. But the most important thing to look at in all of these 10Q is always going to be the risk factors, since these are very explicitly called out by the company as things that can affect their business. Now, this isn't just your average warning, it's a going concern warning. This means that there's real uncertainty if the company can stay in business for the next year. A lot of this comes down to being unable to comply with certain agreements and reliance on capital that may or may not be accessible on terms favorable to them as them. Okay, let's break all of this down in a way that's easy to understand. Fluent is facing some serious problems right now. Their revenue is down, their losses are up, and they're not even sure they can stay in business for another year, according to them. One of the biggest issues is that they've had trouble getting high quality traffic to their sites. Traffic is everything to this kind of performance marketing company. Regulations and other things have made that harder to get, and that has impacted their business as a whole. They're trying to get out of this mess by focusing on a new part of their business, commerce media solutions. But for now, that's just not making enough money to make up for the losses. On top of that, they're also trying to cut costs wherever they can. Now, looking at these results more broadly, the risks are high for Fluent, but it's not like management is sitting still. They're trying to grow the commerce media solutions to adapt to a world where regulations and supply problems make their traditional business hard to maintain. Here's the thing, if they don't find a way to turn things around fast, there is no point to their existence. Alright, that's our breakdown of Fluent's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.